And here we are on another Thursday. Zach Strickland, head of market intelligence. Tony Mulvey. What do you do?
Senior analyst.
That's right.
Come on now.
Every week, I'm going to keep asking until I remember.
Or you're just going to make up random job titles.
And of course, the freight market and the macroeconomic environment remain in fluctuation. I think we're in a state of transition, continued transition. Things don't necessarily have to change overnight. August, a transitional month to an extent, but we have a few nuances as we have now formed over time. The rail labor strike in Canada, as well as some potential striking going on the eastern seaboard.
Yeah, I think that's the part that's not been talked about a lot, is like the potential on the East Coast we talked about the labor unions on the West Coast not long ago about their, like, now same issues are going to be on the East Coast. And I mean, you look at the timing, it's not the time where you want to be dealing with a strike with your
time
union.
That they would actually have leverage, and we'll talk about that here in a few. But first, I'd like to thank our sponsor, Netrodyne, for supporting us and allowing us to bring this information to you. Remove the guesswork from driver management and fleet safety and start predicting your accident reduction cost savings. Netrodyne's AI-enabled video safety platform corrects unsafe driving habits, recognizing and reinforcing great driving. With the Green Zone score, your fleet of engaged drivers will protect your bottom line. Every 50 points earned is a 14% cut to your accident rate, which is money in your pocket.
Yeah.
Oh, man.
Safety is safety. Anything that you can do to...
There's a lot of lawyers in the world
that love going after big trucks.
They really do.
So
they literally advertise it.
Yeah.
So get that, look into that Netrodyne activity there. So you want to lead them off with a market update here?
Yeah,
Exactly. Get everybody kind of level set.
I'll lead you in just kind of where we're at in the market. So Zach, your market into in 3, 2, 1.
All right. Do we have a chart? There we do. All right. Outbound tender rejection index. I've been leading with this one for a while because I think it's probably the most telling and descriptive of the current market. You see that the tender rejection index actually has dipped back down below 4.5%, still at a historically low level, but it is above. If you look back just a few months ago, we were sitting and hovering around 3.5% in April. So it is a scale higher, a step higher. It still supports the concept that we are transitioning to a tighter environment. And we're also tighter than we were in 2019 consistently at this point. 2019, as you recall, was another transitional market where we were moving from a loose to a tighter environment as capacity was exiting. That's exactly what we have now, but there's a lot more capacity probably than there was. And now that is moving at a faster clip, therefore pushing the rejection rates through that boundary of 2019. I'm really looking at you, fourth quarter, for this index. Let's move on to the next chart here and look at the NTI. In blue measures spot rates for dry van, and the refrigerated truckload index, RTI, in white. Refrigerated is still showing signs of being more disrupted at this point in time, although we are seeing a near-term downward correction. Looks like rates are coming down over the last week, just slightly. Still, though, the overall trend line of increasing since May, April is still intact. Dry van sector down there on the bottom, not as volatile, not as responsive, but still, I would say in that trend line, you kind of cut off that peak there around July 4th. We're approaching Labor Day. I expect spot rates this time next week to be creeping a little bit higher, and certainly here in 2 weeks. Let's move on to the next chart. A little nuance here. I like to call out some of these markets. This is a noisy chart. Bear with me. But we're looking at rejection rates for Los Angeles falling down. Rejection rates for Dallas and Houston, are two primary Texas markets, starting to creep higher. So we're seeing some shifting in the dynamics of the overall market going on here, Tony.
Yeah, I think this is an area that we've been talking about fairly regularly, is like the ebbs and flows of capacity, especially to the West Coast. You'd start to see maybe a little movement to the West Coast, longer haul freight maybe starting to pick up, but it really hasn't.
Right.
And I think the interesting thing is, like, now you're seeing the exposure that if LA starts to pull in capacity, it leaves some of these other major markets exposed. I mean, we've talked about the Pacific Northwest and the impacts that can have. not big freight markets up there, but you start talking Houston and Dallas, like those are two sizable freight markets that can be impacted. I think Houston, you mentioned on a call the other day that we had, is kind of like this underappreciated market. I mean, massive port. I mean, I think that's where Walmart moves most of their freight through.
Amazon.
So Amazon. You've had the energy sector really exposed there. So I think it's just kind of underappreciated for what it does for not just the freight market, but the overall economy.
It's positioned in an interesting spot, naturally for transportation and logistics, and certainly around the import side of things, but it's also right there close to Mexico.
Yeah.
As we've been talking about nearshoring and the increasing impact there. Some of that freight can go on the water too. It's not that far away. Normally we think about Houston as this chemical and energy, standard, but it's a pretty strong container port as well. A lot of freight volume comes out of there, especially as an alternative to some of this West Coast freight and certainly the East Coast as well. When we're talking about some of these Gulf Coast port strikes, Houston's sitting there.
Yeah, exactly.
Potentially. So very critical, transactional or transitional states of the supply chain involved in a lot of this potential risk that's looming for the third and fourth quarter.
Yeah, and I think those ebbs and flows that you see in like the Houston, Dallas rejection rates going up, LA starting to decline, like that's that state of transition. Like that's what you would expect to see, kind of these fluctuations regionally first. You're not going to see it. I mean, you talked about the national average kind of flatlining. Like, it doesn't mean that there's not these pockets that are changing fairly quickly and fairly significantly at that.
Yeah, and we've got the Houston market pulled up in Sonar Market dashboard here, showing you rejection rates. They're in that blue mountain that you're seeing there, and they're trending higher. I mean, this puts it in a different perspective or context than the noisy chart I just showed you for market and two. But the spot rates going from Houston to, I believe I pulled up Atlanta here, starting to they're trending higher, and they've kind of plateaued over the summer, but they're up. And the Atlanta market had a moment here in the summer, early summer, where it was tighter than expected, but that's kind of fallen away. So the fact that spot rates have remained high going to a market that is in deterioration from a spot market perspective, meaning carriers don't want to go there as much.
Yeah.
I think that there's a read here. I think the rates are actually, you could read this as like rates are actually increasing because they're going into a market that's not as preferable.
Yeah.
Tender rejection rates reflecting that, I think, more cleanly. Houston, though, definitely a market to watch here in the third and fourth quarter.
Oh, no doubt. Especially when you get, you've talked about it before, Labor Day kind of being that the time frame of when some market changes will happen, but then you also have to factor in like there's disruption in the Atlantic Ocean and the Caribbean, right? Like there's hurricane season. Typically, the stronger storms happen around that Labor Day period. Houston seems to be the one, like everybody talks about Florida being impacted. It tends to be along the Gulf Coast.
Two of the last three major weather disruptions to the freight market. When I'm talking about this, I'm talking about the polar activity this January. There was one that shut down all of the Texas power grid during COVID in 2021. And then there was Harvey in 2017. Two of those three were pretty dramatic influences. And two of those included Houston in the mix. Houston had a huge amount of shutdown for Harvey, obviously, but also when the power grid shut down, there was an ice storm and it disrupted a lot of shipping networks. And it took weeks and, of course, months for the COVID one, but weeks for it to really recover.
Yeah. It should be important, right? It's the fourth largest city in the country. It should be important. We talk about and it has a port, right? Like we don't talk about like New York, but it kind of Port of New York, New Jersey's big, but it feeds into like Harrisburg and then moves out from there.
Like everything's within 100 miles.
Yeah, it's very different than call it the Houston market that's feeding. It may feed into Dallas, but it's going from Dallas outward to,
short haul freight does not disrupt the market.
No. And you see that because we've seen short haul volumes up 20% year over year, something like that. that's not been disruptive. It's helped boost that overall volume index, but that's why that increase in volumes maybe isn't felt by everyone in the market because it's been so kind of segmented to that shorter length of haul than the longer length of haul that the freight that everyone's looking for. That's really kind of been, I don't say challenged, but it hasn't seen growth in the same way.
Right. Well, let's talk about the economic situation here before we get to some of the stories about the labor disputes.
Yeah.
So what do we got this week? What were some of the releases?
Big macro week. So this morning we had retail sales came out 1% higher month over month, better than expected. They were expecting a 0.3% increase. So clearly consumer spending, if you strip autos out of that. So both autos and gas up 0.4% month over month, up a little over 3% year over year. Pretty good, especially when you factor in the CPI that came out yesterday morning. A lot of macro data this week. It came out up 0.2% month over month, up 2.9% year over year.
Which is within the target.
Which is, you're getting into that target range, right? Like sub 3%.
Sub 3.
Now, on the core aspect, you're up 0.2% month over month again, but you're up 3.2% year over year. So the numbers continue to trend slightly lower. The concern, I think, there, from my perspective, is the shelter prices. That was kind of a re-acceleration in the increase there. That's about 90% of core inflation. So it's really weighted towards shelter. I mean, you're talking.
It is important.
Yeah, you're talking right around between 4.5% to 5% increases year over year. It's still pretty inflationary.
Right.
So, like, there's been a lot of progress made to inflation. It's still not.
But if I'm, Powell, like, that's something people have to spend money on.
Yeah.
Shelter is at the top of Maslow's hierarchy of needs.
Yes.
Like, you have to have that. Yeah. Water, food, shelter.
Yeah.
It's there.
It is. So I think for that, it's funny. I mean, if we talked on Monday, like, I would have told you a rate cut 1,000% is going to happen in September. Like, everything suggested that it's going to happen.
Right.
But then you still see the signs that, hey, the consumer's spending money. Some of these areas where we need to see inflation improve, like, it's improving, but maybe not as fast. Maybe they're a little more hesitant to cut rates in September. I think that's ill-advised. I think they're already late to kind of cut rates.
Right.
But
just like they were late to raise rates.
Yeah. So
which created the need to spike the raise.
Yeah. So to me, it's like, and then what happens in the labor market, right? We had this the labor market report for July that came out, I guess, 2 weeks ago now. Like, there's nuances in it. It was an influx of people entering the labor market, which is why, like, unemployment ticked up. You had this, like, increase. If they find jobs throughout August, like, that unemployment rate could, be
a short-term blip.
It could be a short-term blip, right? This, like, bumpiness in it, which, if that happens, guess what? Like, they're just going to say, okay, no, the economy's still in this relatively strong state. It's still absorbing the rate increases that we've had. There's no reason, like, inflation data is trending the right way, but we don't need to cut rates right now. It's very different than what it was on Monday, which is interesting how fast, like, the dynamics changing. But, and then you've had earnings this week too, retail.
Two of the biggest retailers.
Yeah, you had Home Depot and you had Walmart.
And two huge importers, by the way.
Yeah. So Walmart, think of kind of the value, right? We're the country's largest grocer, value play. You had comp sales, excluding fuel, in the U.S., up 4.2% year over year. You had a reduction in inventory, which, again, is dollars, not number of goods. So it can be a little skewed by what they bring in versus what they have in inventory, what they don't. But it was down 2%. So
I think that's a good read, though. I mean, we talked about this over the last couple of weeks about how inventory levels are still high for some of the people out there. And it's like, well, not really. Like, the aggregate numbers, there's, like, we talked to Zach Rogers.
Well, and he talked about it. The retailers are still leaning out, thinning those inventories.
They're lean.
Yeah.
It's the upstream people that are stockpiling a lot of the inventory.
Yep.
So the data supports retailers actually having pretty lean stock, which supports potential for just, like, volatility later in the year.
Yeah, absolutely. And then you had Home Depot on the other end. So kind of that home improvement, we've talked about it on here. Home improvement sales from Bank of America's credit card spending been down year over year for quite some time.
Several months.
Home Depot comp sales down 3.6% in the quarter in the U.S.
Yep.
Inventory also down 1% year over year. So again, I think the theme overall has been you're running slightly leaner inventories than where you were after they had that massive boost. They've reduced them back to levels they feel are healthy, and they're operating kind of in this little range.
Right.
And consumers are fleeing to value.
Right.
And I think you see it. Home Depot is not cheap by any means. It's not a necessity right away. Walmart tends to be more on that less discretionary.
Walmart, these two companies are great examples of economic disparity.
Yes.
So you've got Walmart as the discount retail provider of numerous consumer goods. And then you have Home Depot that really focuses on home improvement and building materials and things like that. And that is two very different sectors of retail. And the home building sector it got a lot of that overheating during COVID because everybody was at home and they're looking around their house going, I need to get to that project. The honey-do list got expanded. And now with everybody going back to work and being busy again, it gets a double hit because now if you got adjusted to that higher level of spending at Home Depot, it's really challenging to figure out where's this going to settle out. And the economic situation is such that it's also kind of taking another hit simultaneously.
Yeah, I think the one that'll be interesting to watch actually comes out next Wednesday. Target kind of tries to play itself as a little bit
not discount,
little higher value than Walmart. You see shoppers, that's where that trading down comes into effect. I mean, you look at on the grocery front, Aldi being the fastest growing grocer in the country. What happens there? I think that's the one that's far more interesting because they were the ones that really called out their inventory problem first.
Yep.
What happened? What does their sales look like, their comp sales? Because I think that's a good gauge of what's the consumer kind of doing.
Samsung also is going to be one to watch because they got labor issues.
Yes.
I mean, it's labor issues abound here that all have pretty strong downstream effects, and especially on our economic environment. Because what if they strike and then there's this gap in their supply chains now, and now they have to recover quickly, especially heading into retail peak season.
Yeah, that's not the time that you want that to occur.
Well, let's break down some of these situations. We've got lots of disruptions on the maritime and, kind of that infrastructure entering the countryside. The first one I want to call out, though, we're talking about the China port explosion snarls Trans-Pacific container trade. Ningbo, third largest container port in China or in Asia, is basically there's an explosion and it's shut down.
Yeah.
So think about this. The big takeaway here is that if there's a bunch of freight stalled out at the third largest container port in China, all that downstream impact, that doesn't ship for a few days. Think about what happened at Port of Houston when everything shuts down for a few days. It takes weeks to recover that.
Well, it does. And then the other flip side is once it's here, right, it creates the delays because everything's getting here around the same time.
Bottlenecks.
It's over time, it plays out. I think
you've got rerouting. You've got all sorts of dwell time increases, tightening of available container supplies because you've got unbalanced networks now, things like that.
Yeah.
So definitely something to watch. We haven't really seen it play out in any data just yet. So it's definitely just going to be something to pay attention to. But I think more closer to home, container imports could approach monthly record. This one here kind of lining out that a lot of these disruptive forces, such as labor disputes, the Port of Ningbo, all have a potential of creating this wave of imports. Now we have some data on this. Now this is the IOTI, the Inbound Ocean TEUs Index, if we have it. Not sure if we do. Yeah, we do. Here we go. Peak season for maritime shipping happens July, August, traditionally. Everybody was thinking, oh, wait, you see how that actually increased into June? Well, it actually increases again. We have this secondary step. Now, a little bit of spikiness here. I don't know that we can take that as a pure signal that things have gone totally chaotic, but I think the sign here is that we're not out of peak season and it's not showing signs of really being slow. So this really starts talking about how we've got a near record surge as shippers look to get holiday goods ashore in August. Retailers bring in merchandise ahead of potential job action at East Coast and Gulf Coast ports this fall. You got a contract between International Longshoremen Association and the United States Maritime Alliance expiring on September 30th.
Yeah. So, I mean, if you think about it, it's actually really bad timing for that to expire because you have Golden Week that tends to be kind of early October. Kind of marks the end of that peak season. So you're going to front run that already. And now you have this potential labor dispute that's going to end, a week before that potentially, but they're going to be in negotiations well before then.
Yeah.
And you may not get an answer. Well, you've got to act to ensure that those goods are where they need to be and clear through the ports and whatnot prior to that happening, which means you have to move them now versus, if you were going to move them in the first week in September, well, now you need to be moving them in the middle of August to beat that.
Now you
but
can't
then
wait.
Everybody reacts to that. It's not just like, oh, we're going to do this. Well, one does it. Well, this vessel fills up and everybody's like, oh, it creates it's very similar to the panic buying that we saw with toilet paper and things like that.
Let's not go that far.
No, but similar idea. Once one does it, things tighten up.
Right.
Well, now we have to react to that. So it kind of has some of these knock-on effects in some cases. So I think overall, it may not be as disruptive as it was in the past, but I think it sets up for freight volumes in the back half of the year to be, or in the last, call it fourth quarter, to be far stronger than where they are currently.
Probably the biggest call out I'd say here, we calculate that the shift has pushed the West Coast share of cargo we track to above 50% for the first time in over 3 years.
Yeah,
according to Hackett.
It had been in the 40s.
And that right there, all that stuff that happened during the pandemic, all that East Coast share that was gained, basically it's gone.
Yeah.
Is what that's telling me. And also that means that Los Angeles, Long Beach, having an outweighted exposure, all that freight originates on the West Coast and hops on surface transportation at a much more disproportionate level.
Yeah.
Anybody looking about Southeast, Savannah, Houston, they've lost some share back to the other side of the country now.
Yeah, absolutely. And I think what's going to be interesting is, one, how does that freight end up moving?
Yep.
We've talked about it. You look at short haul volumes, especially in LA, Ontario, they're booming. Eventually it's going to go somewhere else, whether that goes via intermodal to Dallas or Chicago. You hear JB Hunt talk about it, they're seeing double-digit volume growth out of LA.
Yeah, the intermodal side of things.
Is booming, but what you're not having is just this tremendous, you haven't seen it in the truckload sector. No. And eventually you will.
Yeah.
It's just a matter of, when does that timing actually happen? I think that's going to be the biggest.
Well, this is the time of year where everybody brings their goods in to get ready for the fourth quarter.
Yeah, and then they move it to the place where it's going to sell eventually.
The fulfillment side. This is warehouse staging time of year. So a lot of this gets thrown into a warehouse where it's sitting. Although inventory levels are not, the wholesalers, for sure, they're growing. And that's what Zach Rogers was talking about. Yeah. Upstream is growing. Yeah. Downstream, not there, which means all that freight, if demand remains, will go downstream and eventually have to be put into those downstream fulfillment centers. And then the last article here to talk about just supports this. Early peak drives record LA port volume. The Port of Los Angeles handled a record-breaking 939,620 foot equivalent units in July, up 37% year over year. Again, everything's shifting to the West Coast. We've got more of it.
Yeah.
And it's going into these warehouses. And at some point in time, there could be a potential floodgate that opens that all this freight starts moving east. And I don't think that we're right there yet. But this downstream exposure of low inventory, once demand hits, some of the chances of some of these shippers and companies being taken off guard with lower than necessary inventory, the worst thing that can happen to these companies
is to not have their goods on the shelf,
is to miss demand and revenue generation potential in the busiest time of year. It's far that creates that sense of urgency.
Yeah. That's where you'll see upward pressure on rates, because one, carriers and brokers will understand it because the urgency's picked up.
Mm-hmm.
But from a shipper side, it's revenue protection, right? So they're willing to spend more in transportation costs in that sense.
Yeah. And then
to guarantee it.
Didn't really get to this, but the Canadian strike, of course, in process probably for August 22nd.
Yeah,
it looks like it's looming.
Next week, we'll be here, and
not a huge impact on total North American volume, but an impact nonetheless.
Yeah, exactly. So we'll be back next week.
All right, everybody have a good one.